Welcome back to Synaptic Dividends. All right, let's get right to it. Today we're tackling a big question, one I know is on a lot of your minds. Is AbbVie's dividend the rock-solid income stream we all think it is, or is there a crack forming in the foundation? Let's dig in and find out.
You know, for what feels like forever, AbbVie's entire story was built around Humira. I mean, this drug was an absolute cash machine, one of the best-selling of all time. But now, that fortress has been breached. The patent protection is gone, competitors are swarming in, and that leaves us with the million-dollar question, right? With its golden goose gone, is that famous dividend now in serious trouble?
Okay, so to get to the bottom of this, we've got to cut through all the noise. You see all the headlines, right? But what really matters is finding the one number that tells the true story, the real safety number. And if you just glance at the surface, things look, well, terrifying. Seriously. You look at the standard net income payout ratio and you see a number over 300%. You're thinking, wait, what? They're paying out 3 times what they earn? How is that even possible? But, and this is a huge but, that number is incredibly misleading. The real number, the one that truly matters for us dividend investors, is the free cash flow payout ratio. And that number, it's sitting around a much more comfortable 55%.
So what's the difference? Why is one number so scary and the other so reassuring? Well, think about your own paycheck. Net income is kind of like your gross salary. You know, that big number before they take out taxes, insurance, all that stuff. But free cash flow, that's your take-home pay. It's the actual cash that hits your bank account after all the bills are paid. And that's the money a company can actually use to pay us, the shareholders. AbbVie is only using about 55 cents of every dollar of its take-home cash to pay its dividend. That's a whole different story.
And check this out, the history here really backs it up. You can see back in 2022, the ratio was incredibly low, just 42%. Now, yeah, it did jump up to 58% in 2023. That was the first year Humira really started to fall off. But you know what? That's still a totally manageable number. And even better, look at the last 12 months. It's already trending back down to 55%. This isn't just theory. This is the proof right here that the company's other drugs are stepping up and filling that cash flow gap.
All right, so that's pillar number 1. The dividend is safely covered by cash. Huge check mark there. But that's just the start. Let's look at pillar number 2, which is all about the track record. We're talking about an incredible history of consistency. Just let that sink in for a second. 53 consecutive years of dividend growth. That means for over half a century, through oil crises, the dot-com bust, the great financial crisis, a global pandemic, through all of it, AbbVie and its predecessor have given shareholders a raise every single year. That's not just a nice-to-have, folks. That is baked into the company's DNA. It's why they're a certified Dividend Aristocrat.
But here's where it gets really interesting. If you look at how fast that dividend has grown, it tells a story. Go back 10 years and you see this explosive growth, right? Almost 13% a year. But look at the last few years. It's settled into a more, let's call it mature growth rate, around 4 to 5%. Now, some people might see that and panic, but that's not a sign of weakness at all. It's actually a sign of really smart management. They're being prudent, balancing those dividend raises with paying down debt and fueling the research for the next blockbuster drugs. It's the classic shift from flat-out sprint to a strong, sustainable marathon pace.
So we have safe cash flow coverage, and we have a legendary history. But what happens when the chips are really down? I mean really down. How does this company behave when the entire economy is in a nosedive? That, my friends, is the ultimate stress test. And wow, just look at this. During the 2008 financial crisis, when the whole world felt like it was ending, did they cut the dividend? No. Did they freeze it? Nope. They raised it by almost 11%. Then, fast forward to the 2020 pandemic shutdown, total global chaos, and what did they do? They did it again. Another 10% raise. This tells you everything you need to know. For this management team, the dividend isn't just some line item. It's a promise, a core commitment they honor, especially when times are tough.
Okay, we've seen the cash flow, we've seen the history, and we've seen how it holds up under extreme pressure. So let's bring it all home and give our final verdict.
So, let's recap. First, the dividend is safely covered by the company's actual take-home cash, with a payout ratio right around 55%. Check. Second, it's supported by a 53-year legacy of giving shareholders a raise, year after year. Double check. And third, it's been battle-tested in the fires of 2008 and 2020 and came out stronger. The conclusion here is pretty clear, isn't it? Based on the numbers, this dividend is absolutely rock solid. Now, these numbers are fantastic for telling us the what, that the dividend is safe, but they don't really tell us the how or the why.
If you want to go deeper, to really understand the business itself, the new drug pipeline, the competitive landscape, the whole shebang, then you've got to check out our full in-depth explainers on our main channel, Synaptic Investing. Because while the dividend looks great today, the big question for the next decade is, can they do it again? Can they find the next Humira?